Lesson 9, the liabilities side. Till now, we've covered the asset side on the balance sheet, and in this lecture, we're going to see the liability side and how the components of liabilities are important for you to understand financial statements. What are liabilities? Most textbooks define liabilities as an economic obligation of the business. In simple terms, liabilities are monies that the business owes to others. These includes bankers, financial institutions, vendors, suppliers, employees, etc. And just like assets, liabilities are also classified into current and non-current liabilities. So this is the typical side of a liabilities statement of a balance sheet. As you can see, you have the current liabilities on the balance sheet side, and just like current assets are receivable within 12 months, current liabilities are monies that are payable within 12 months. So current assets provide cash within 12 months, whereas current liabilities take cash within 12 months. Let us look at the components. The first component is accounts payable. So accounts payable are bills generally to businesses for materials, goods, and services which are purchased on credit. Do you remember the accounting equation where we tried to give you an example of how inventory was purchased on credit and therefore it was shown on the liability side? This is that inventory portion which is payable to vendors and which is being bought on credit. So typically businesses, when they buy materials, they usually take a 30-day or a 60-day or 45-day credit. Until the time it is paid off, it is shown on the liabilities side. The next item is accrued expenses. Just like accounts payable, these are also amounts that are accrued but not yet payable. Let's look at an example. Assume that you've taken a factory on lease, where you have quarterly lease payments that are to be paid to the owner. So let's assume that the quarterly payments are $9,000 each. So every month you accrue $3,000 as accrued expenses, because these are accruing in the month, and under the accrual concept you accrue the expenses as and when they are due. So you accrue these expenses under the head accrued expenses. So accrued expenses at the end of January is 3,000, accrued expense at the end of February is 6,000, accrued expense at the end of March is 9,000 till the time that you pay the expense to the owner. Next, current portion of long-term debt. Now, if a business has borrowed money which is repayable over a long period of time, which is more than 12 months, the current portion of that long-term loan is shown under current liabilities. Let us look at an example. Any loan taken from a bank is a liability because you owe it to the banker. Let's also recollect the definition of current liability. It's a liability which is repayable within 12 months from the date of the balance sheet. So let us take a look at an example where Joe has borrowed $40,000 repayable over 4 years as shown in the diagram. Now the current portion of long-term debt as at beginning of the period is $5,000, which is the amount which is payable in year 1. The current portion of long-term debt as at year 1 is $10,000, which is the amount payable in year 2. And the current portion of long-term debt in year 2 is $15,000, which is payable in year 3, and so on. So current portion of long-term debt is the amount which is payable to the banker for the next 12 months. Other current liabilities can include all other liabilities which are neither classified in K, L or M, and it could include items such as tax payable, etc. So this is current liabilities. The next item is long-term liabilities. Long-term liabilities are loans which have a repayment period of more than 12 months. Now, as mentioned earlier, the current portion of this long-term liability is shown in current portion of long-term debt, and the balance, which is long-term, is shown under this head. Let's go back to our example. So as at the beginning of the year, the current portion of the long-term debt is 5,000, which is repayable over the next 12 months, and the long-term debt component is 35,000. As at year 1, you've paid the 5,000, so the total outstanding debt is 40 minus 5, which is 35, and this is reported as current portion of long-term debt of $10,000, which is repayable over the second year, and the balance as long-term debt. So similarly, every year, the current portion of the long-term debt and the long-term debt components are split and shown in the balance sheet. Summary. Liabilities are things that are owed by a business. They're shown in the balance sheet in the order of liquidity, and current liabilities are those that are to be repaid within 12 months from the date of the balance sheet, and long-term liabilities are those which are to be repaid after 12 months from the date of the balance sheet. And as we discussed, the current portion of long-term debt is shown under current liabilities.